John, you use your guru-based investment approach to analyze stocks. How exactly does that work?
Basically, it looks at some 300 different variables, from earnings to the financial statements to debt, the relative strength of the company, and then tries to emulate the investment masters of the last 75 years in terms of their thought processes in picking a stock.
So who are these investment masters, these gurus?
One of them obviously is Warren Buffett. The second is Peter Lynch. Another is Martin Zweig. Benjamin Graham, who is actually Buffett's professor. David Dreman, who's a great contrarian. John Neff, who's into value and dividend stocks. Those are some of them.
Now, it's just to focus on one, let's just take Buffett for an example. What goes into that strategy, and how has the performance been, say, over the last year?
The performance of the last year has been outstanding. The strategy has actually been up 52% over the past 12 months, which is interesting. You compare that to Berkshire itself. Berkshire's been up 34% over the past 12 months. How it essentially works, the first thing it looks for is a consistent earnings pattern over a 10-year period of time. Now, most strategies actually don't look for 10 years worth of information. They go for 3 or 5 years. But Buffett is unusual that he wants 10 years worth of data. And the reason he wants that is to look for earnings predictability for the future. So generally, these particular stocks will have steadily increasing earnings over the 10-year period of time. The next thing is a high return on equity, again over a full 10-year period of time. Debt to equity is also something that is looked at. In particular, Warren Buffett wants to see stocks where the debt can be repaid in between 2 to 5 years from the earnings of the company.
Right.
That's an unusual criteria because debt to equity is the more common criteria, but he looks compared to earnings.
Now, is there any overlap with the Buffett model compared to his actual portfolio?
Actually, yes, there is. In several cases, there's Walmart, there's Johnson & Johnson, there's Nike, there's Becton Dickinson. So there are actually several overlaps.
Now, do you personally have a favorite strategy across the gurus?
I actually do not have a favorite strategy because each of the strategies are unique in their own special way. Zweig looks for the growth. Buffett, of course, has his, the fact that he looks for 10 years worth of data, and a lot of other criteria, and a particular buy point is also very, very valuable. The Dreman contrarian strategy has also been excellent for looking at value stocks and finding highly unpopular stocks that tend to do well.
So it just depends on your personal appetite for risk and what you're looking for.
It does, but I also actually have a strategy that blends all the strategies together. So you don't have to make up your mind in terms of which is your favorite.
Which you want to pick. Now, so what are some of the challenges investors face when trying to implement these strategies?
The hardest challenge is to follow the actual strategy itself. When the strategy recommends buying 10 stocks at a particular time, it's actually pulling the trigger and buying those 10 stocks at a particular time, as well as selling, not trying to cherry pick it and not trying to...
So being disciplined.
Being disciplined, exactly, and being non-emotional about it. A second really key thing is to have the patience and the belief in the integrity of the system to stay with it even when the system is out of favor. You have to follow strategic methodologies through thick and thin in order to benefit from it. And that's one of the things that the masters have done. They've pretty much stuck to their particular strategies, not trying to chase whatever the hottest strategy is.
So the economic environment has, changed over the last couple years, over the last, century. Do you think the strategies will continue to work, and is there risk with the changing environment that these won't be valid in the years to come?
Actually, I'm confident they will continue to work. These strategies were selected because they were the very best ones over the last 75 years where the person actually disclosed the strategy that made him successful, and he had a successful track record. And then we've been actually looking since 2003, these strategies still continue to work and dramatically outperform the market even over that time. So I've got a lot of confidence in that. Now, that said, one of the reasons these strategies still continue to work is because they don't always work. And what I mean by that is there will be some years when they fall out of favor and they don't work, and at the end of the year, the investors will say, this can't possibly work anymore, and they're on to something else.
Right. So they're constantly evolving within themselves.
Constantly evolving, constantly evolving.